Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-hosts for Upticks.
Today is our 32nd episode. Look out.
We're going to talk about red flags, questions worth asking, and the Callan Chart.
Okay, Corey, so for our first segment of today's show, we wanted to talk about potential red flags that people should look for when they're interviewing to work with financial advisors. You know, you and I have been in the business for a good time now, and we've come across many advisors, and we've obviously met with a lot of clients. And to us, it's comical what some of the advisors out in the marketplace are telling people and some of the weird things that people actually believe. So we wanted to help our audience look for warning signs if they are looking for an advisor. These are things that maybe you should drill down and ask a little bit more questions. So a common one that a lot of advisors will use is that they are the manager of managers. What comes to your mind? What comes to your mind when somebody says that to you? I'm a manager of the managers.
Two things. One is, what does that really mean? What the heck does that mean? And two, if you're a manager of managers, what are you really doing?
Right. And so what I hear fees on fees.
Yeah, that too.
And so when an advisor says this, basically what they're implying is that they pick money managers or mutual funds or products for their clients, and they quote unquote manage those people. So that's maybe a little confusing to a client. It's like, what are you talking about? So they're talking about they are managing the managers. But when I hear that, I hear you. So you want me to pay you a fee to watch somebody else that's also charging me a fee. So to us, that's a huge red flag. Why wouldn't you just cut one of those people out?
I don't know. I think because that's, I guess, the way it's always been. Right? For a long time, it's been pretty standard that financial advisors invest their clients' money into mutual funds or whatever avenues where there's other people managing it. So basically, a client is paying an advisor fee to manage the mutual fund managers that are also charging a fee.
But can't a client just see their managers or their mutual funds performance and determine if it's good or bad?
Pretty sure, yeah.
I mean, I get it that some of these advisors, they might get accreditations and say, I know how to look under the hood of a mutual fund more than the common person, which is probably fair.
Yeah, that's a common look under the hood. What does that mean?
Yeah, exactly. I mean, at the end, they're slapping you in products, and what they're trying to do is take the spotlight off of themselves and say, it's not my fault if your account goes down, it's the manager, and I'm managing them, so I'm going to fire them. And, But
if you picked them.
Right, it's still your fault. And that's... so we used to buy mutual funds for our clients,
right.
And we stopped doing it because we didn't like our clients' capital being exposed to something that we didn't have direct control over. And so we didn't see a reason to outsource this. Now, you mentioned when I asked you at first, what does that mean? And then what was your second point on that you made?
What are you actually doing? In
Gotcha.
other words, it made me think of, the scene in Office Space where they're like, what is it exactly that you do, right? And the person doesn't really have a good explanation.
Yeah. So, for us, at least in our viewpoint, if you're going to hire an advisor to invest your money, then they should be picking the investments.
Yes.
They shouldn't be putting you in products. You can go, especially now with technology, it's really easy for you to go directly to these mutual fund companies. They're happy to sell you their stuff and go buy the product directly. And then maybe you pay an advisor a one-time fee. I don't think there's anything wrong saying, hey, I want to give you a few $100s. I want you to help me pick some mutual funds. I understand that takes some time. But why would you pay an advisor an ongoing asset-based fee on top of the mutual fund or products fees to do something like that? It's could be potentially a one-time exercise. Now, I get it needs to be somewhat monitored, but again, you don't need to have manager of managers. That's my little red flag number one here. Let's move on to maybe another one. What's another red flag that we hear out there commonly when we're meeting with people?
People will meet with other advisors that guarantee them something.
Yeah. So that's a big no-no, by the way, in our industry. So if an advisor sits across from you and says you're going to get a guaranteed return, I'd be very leery of that person. Typically they'll probably try to package it in some sort of an annuity or insurance product.
That's usually what it is.
Yeah, but there are no guarantees ultimately. I mean, when you're dealing with the future and you're dealing with investments in the market, sure, an insurance company can quote unquote guarantee, but if the insurance company goes out of business, how do you know that that's still going to happen? So again, that's a good one. Guarantee is a big red flag. Another one that I hear a lot are that bonds are free. I think that's a huge red flag. I don't know the psychology behind that either. Like, why would an individual ever think that a person sitting across from them is going to invest their money and not get paid anything to do it? They're going to do it for free just because they like that person and they're a nice guy.
I don't know.
I don't know either. I don't think I'll ever be able to wrap my head around that. That if an advisor looks at you and says an investment is free, my immediate next question as a consumer would be, then what's in it for you?
How do you stay in business?
Right. Then how are you paying rent and your employees, and how are you getting paid? And, an advisor needs to be transparent. There's a big difference between not charging you an annual fee and an investment being free.
Great point.
Those are two completely different things. So I get it. An advisor can do that and say, look, on your bonds, I don't charge you an annual fee. But they should go on to say, but when I buy and sell a bond, I'm going to charge you a commission. I think a lot of times they leave that out. How convenient, right? And the poor client leaves the office thinking, oh, my bonds are free. Corey, he's a really nice guy. He's not going to charge me anything on those bonds. It's free. I really like Corey.
But if somebody goes and buys $100,000 worth of bonds and they're not charging an annual fee, but they still might charge $2,000 in upfront commissions.
Yeah, there's a markup. It's called a markup.
That you just don't see. It's not reported to you clearly.
Right.
It ought to be, but it's not.
Yeah, and I think the industry's actually made some waves to make that reporting happen. But again, a lot of clients, unfortunately, they don't look at their statements that closely, so they might oversee it. So if an advisor tells you anything's free, that's another big red flag.
As far as looking over statements and not understanding it, and even the first point you said about manager of managers and looking under the hood and this and that, I think there's a theme to this that I believe in some ways that Wall Street, I'm using that term broadly, has almost made things complex, probably more complex than they are,
right?
To convince customers and consumers that I'm so smart, I know so much, there's so many things you can't understand, therefore you should pay me a lot of money for my expertise.
Right, that's a good point. So they overcomplicate things.
Almost intentionally. It's like if you look at an annuity contract, it's kind of like, why does this have to be 100 pages long?
Right.
It shouldn't be that complicated.
That's interesting because on our website, right on the main page, we talk about how we're redefining, basically financial advice because we look to peel back those layers and go back to simplification, and we're buying individual stocks, we're buying individual bonds, we know why we're doing it, and it's a lot simpler way of doing things. Now, it does take us a lot of time and research to do it.
Sure.
But the client, they look at their statement, they see they own shares of XYZ stock, and if they have a question about it, they call me. It's that simple. It doesn't have to be, like you said, these complex 100-page prospectuses and documents, and
it's complicated on purpose so nobody can actually figure out what they're actually paying someone.
That's a good point. What about, let's see, I wrote down some other red flags that I wanted to talk about. What about changing your target rate of return based on a bad year?
Based on a bad year, that's just, to me, that's in a way trying to predict the future, which can't be done. But I think, here's the way I see it. If we are building financial plans for our clients and we're trying to project the next 20 or 30 plus years for them,
right?
What data should I use to try to make those projections as accurate as possible?
Good point.
My hunch? What happened last year?
Right.
Or what's happened over the last 90 years?
Right.
What would you want as a client?
Right, exactly. I'd want typically the longest set of data points is going to give you some sort of average that would be much more realistic than your hunch or 1 year.
Not to mention not just theoretically, but in reality, if somebody lowers your target return, they are quite simply lowering your expectations of them based on what happened in 1 year.
That's a good point.
If I said, you know what, we've planned on trying to make 6.5% for you, but from now on, my new bogey to hit for you is 4%.
Good point.
So then you almost get conditioned to think that 5% is good because it's exceeding my target.
I never thought about it that way. A lot of these advisors out there, they will change their assumptions. And I think sometimes they'll ratchet them up just to make the plan look better. So there's another way to look at that.
True,
sometimes the advisor may be saying, you know what, I could make you 9%. And they're doing that just to persuade you to work with them, which is, again, just setting them, or sell you a product perhaps, right? So
they're setting you both up for failure when they do that.
Yeah, so I think that's very, so one, you should understand if your advisor is quoting you a target rate of return, what that is, and you should ask them,
what's it based on?
What's it based on? And when I was going with this, you should also ask them, are you ever going to change it? And if you do change it, why would you change it? And in our practice, we would only change it if the data skewed largely, again, over that 90-year time, which it would take many, many years of different returns, which so again, I don't foresee us doing that, but it could happen only if the data was inaccurate at that point. But we're not going to change it based on one bad year, and we're not going to change it based on some product or hunch, like you said. That's another red flag. If an advisor's looking to change your target, I'd be a little wary of that and ask them why. Good. Do you have another red flag?
Yeah, here's one that it's one of my favorites.
All right.
In that it's so silly, is that if a financial advisor quotes a client a target return or an expected target return for the market at the end of a given calendar year. For instance, if I sat down and I broke out the math and I said, Jake, well, based on these PE ratios and this multiple, my projection is the S&P 500 ends 2019 at 2839. It's like, are you kidding? Why would you? For anybody to have that level of confidence or bravado that they think that's what's going to happen is silly to me.
Yeah, it's ego. I think a lot of it is ego. That advisor wants to look smart in front of their client.
But what happens when they're wrong? The problem is not even just with advisors, but market strategists or experts or talking heads that we see on CNBC. They get up there, and I'm just sort of picking on CNBC in this example, but I watch it and read it, obviously. But when people come out there and they say, here's what's going to happen. This is this is where things are going to end up. And I suppose if you do that, 20 times, maybe you get it right once or twice. But if you go back and look at what people have predicted in the past and where we're at today, it's kind of like, why are we even giving any credence to what you think is going to happen? Because you clearly have no idea.
Yeah, I think people want to be comforted, though. They want to know that somebody's confident and has an opinion. And so, again, that's why we
Is that a good thing?
No, I agree with you. I'm not saying it's a good thing. But I think that's why they do it. I think that's why people make predictions and it sells ads or whatever you want to, it sells. Yeah. So I think people, though, value people that have confidence in knowing which way, or hoping which way the market will go. So what we do is, we think more in terms of direction. We think more in terms of protection. And so the idea is with our portfolios, we don't know that the market's going to be up or down for 2019, and we're not going to make a prediction. What we do, though, is set your portfolio to participate when it goes up and protect you if and when it goes down. And that's really all I think a competent advisor could and should do.
Right.
Good. Let me see what else I wrote down here. I'd also be wary of anyone who is not a fiduciary. Again, the industry, there's been a lot of back and forth on this, but I would feel very comfortable if I were a potential client asking, are you fiduciary with all of my investments all the time? And if they're a broker, people aren't going to probably come out and say, hey, I'm a broker. That's not a very common or very highly regarded term anymore in our industry. So you just want to make sure that if somebody's not acting as a fiduciary all of the time with all of your investments, you want to figure out why.
I have a quick example to give. I was in a kind of a competitive situation for a potential client with another advisor, and I was meeting with someone, or maybe even I think I talked to him on the phone, and they said, tell me the specific questions that I should ask this other person based on what you're telling me, because coming from a fiduciary, I can obviously be transparent and explain what it is that we do and explain the costs associated with doing business with us. On the other hand, the recommendations they were getting from someone else weren't quite the same, and they were under the impression that bonds were free, obviously incorrect.
Were they? So this other person actually told them that?
Yes. Yeah, they did actually.
Or they at least gave them that impression.
Yeah, okay. Yeah, I guess I can't say that that's specifically what they said, but that's what they heard.
Wow.
So they must have said something to lead them to believe that. But anyway, that being said, I gave them specific questions to ask, and they told me that they went and they talked to that advisor, and in going through those questions, that the person got flustered, and actually it got to the point where the person was like uncomfortable and almost mean to them, like getting overly defensive. Like, I can't believe you're asking me all these questions. Like, just trust me. I'm not, I'm going to do the right thing for you.
Wow.
But didn't even want to address or answer the questions that they had to ask. And it's not like I was trying to set this other person up for failure. I was trying to tell these clients the same thing that I would tell any other people that were shopping for a financial advisor. These are the questions you need to be asking. And if they can't,
what were some of those questions?
One of them was about bonds specifically. I said, if you buy me bonds, if I own bonds in my portfolio, how do you get paid on them? And they said, okay, and what should we be looking for as an answer? And I said, well, there's one of two ways. One is they're going to charge you an ongoing management fee on those bonds because they're managing that piece of your portfolio. Or two, they're going to tell you that they don't charge an annual fee. And if they do that, then you need to ask them what specific costs are associated with buying and selling bonds.
And did you get feedback?
Charging me an ongoing fee.
Did you get feedback when you asked them that? What did that advisor say?
The advisor told them that I was incorrect in, because they told this advisor that I gave them these questions, and that advisor told them that my interpretation or the way that I portrayed how bonds are bought and sold wasn't accurate.
Well, that's crazy.
But didn't sidestep the question. I mean, they didn't really.
So what happened to the client?
They ended up opening and moving their accounts here and working with us.
So they chose to work with a fiduciary. Sounds like that other advisor was choosing not to be a fiduciary.
Right. Or at least not be a fiduciary on some accounts.
Right. And that's the whole deal. I mean, an advisor, if you're a true professional, you really shouldn't get offended if a client asks you. I mean, there's a right and wrong way. I mean, I think a client could certainly be tactful in the way that they approach us. There's no reason to... a person can be respectful, but there's no reason that you can't ask a question. Right? There's some things that we can control, right? And there's some things that we can't control, and that's really all we aim to show our clients is like, look, I can be really good with your financial plan. We can update it. I can control how I have your investments diversified, the bonds and the stocks. I can control what I charge you for those, and I can control in what capacity I act legally. I can't control if you overspend. I can't control if the market doesn't participate, right? There's some things I can't control. So I think as long as the clients understand Jake and Corey are controlling what they can, and I understand that the market's going to have good and bad years, and I understand that it's up to me to give them an accurate depiction of what I plan on spending, then I think that's an example of a good, healthy relationship, right? But any advisor that gets defensive when you ask them how you get paid, again, the whole point of our segment, that's a big
red flag.
There you go. Thank you, Corey. So let's move on to, unless you wanted to add something else.
No, the last thing I wanted to say there, though, is I believe that if you're talking to your advisor and you feel like you're asking them questions, they've been defensive with how they've answered them, I believe that the reason an advisor gets defensive is because they've maybe led a prospective client or a client to believe that they can control things that they actually can't.
Good point.
And therefore they have to get defensive.
Right. Because ultimately I don't really I feel like I try not to get defensive.
Sure.
I mean, I'm human, but
right.
I can't, like I said, I can't control the market, and I can't control what my clients spend from their accounts, but I can do really good planning for them. I can manage their investments directly, and I can be a fiduciary. And that's what you and I work very hard on every day. Good. Thank you. So that's our red flag segment for today. Let's switch gears a little bit and talk about questions worth asking. So I think I was going to ask you first, right?
Sure, fire away.
So let me ask you first a question that you said a client asked you lately, and I think it comes up a lot, is, let's see here. So how do politics impact my investments?
It's a fairly common question in the political environment that we're in now, and I think it's a perfectly fair question. The really short, condensed answer...
Don't get defensive. I'm just kidding.
The short answer is they don't really impact our overall investment strategy. They don't really impact the long-term trajectory of the market. Sure, this year, last year, the market has traded up and down depending on, whatever the headline is about the current administration or, whichever party is taking control of the House or whatever, the midterms, whatever it might be. The fact of the matter is, though, we've had great presidents, we've had horrible presidents, we've had good administrations, we've had bad administrations, and throughout all of that, the market has, persevered and has grown to the point to where now it's, over a long enough time horizon, the market's gone up. But with that being said, on being a little bit more tactical in regards to specific companies that we might invest in, sure, there is, some companies or some sectors that might stand to benefit more from a Republican administration versus a Democratic administration. And if we are, researching that and have, convincing is probably the wrong word, but, factual research available to us to lead us to believe that, this would be a better way to try to profit for our clients based on, whatever administration is going to take control, we'd be silly to dismiss that or ignore it. But we're not going in and trying to turn things over based on, the latest tweet or the latest headline or even the next House or Senate or president.
So what I'm hearing is we're aware of the political landscape. We obviously know the Democrats picked up seats in the House and we have a Republican president. So if certain sectors in the market are planned to perform well as a result, we might shift our stock allocation in one direction or other a little bit. But going back to your point that you made in the very beginning, it doesn't matter. And actually, gridlock is good for the markets. Historically speaking, the best environments have been when a Democrat has been in the White House and the Republicans have controlled Congress. You can think of the Clinton years. Second to that has been a Republican in the White House and Democrats controlling the Congress. So by the Democrats picking up seats in the House, it has created more of a gridlock environment, which should create less uncertainty, which would be a good thing for the market. The market doesn't like when Washington has complete control because then they can change the laws and really start skewing things all over the place. So gridlock is good. I've also heard you say, we won't be ignorant to the fact that if we think a certain sector is going to perform well because of the political environment, then we'll try to take advantage of that.
Let me give an example. Like after President Trump won in 2016, when he won the election, a lot of people didn't expect that to happen. Certain sectors of the market did very well, naturally, like energy companies, because it was an initiative to ease some regulations that they saw as burdensome. Right or wrong, that's a different discussion, but that was an interpretation. Financials, banks, very similar there in that that sector did very well out of the gate because the expectation was they would ease regulations there. And defense spending, right? So, your companies that contract with the government, companies that, build or produce goods for the military. It makes sense that those sectors did well.
Right.
And on the flip side, if there's a Democratic president, think of when Obama was in office, healthcare companies did really well.
Right.
So
we're aware of that political landscape. We're not going to go all in or all out, and we're definitely not going to try to predict the future.
Right.
But if we're in an environment, okay, we know that the next 2 years, we know what the House is going to look like, we know what the Senate's going to look like, and we know what the president's going to look like. So we can make small changes in our portfolio to hopefully do well in this type of environment. And I think that's another point of why we don't use products. Again, we're more mobile in that we can make adjustments like that. But the takeaway of that question is it doesn't matter.
Yes.
So don't get too caught up on tweets or what's going on with walls or with China or whatever. All that stuff will get figured out in the end. I mean, like you said, we've had good presidents, we've had bad presidents, and all that stuff will get figured out in the end. The market is resilient. Ultimately, companies just want to know what type of environment they need to play in so that they can make adjustments and plan accordingly. And then in the end, they're going to find a way to be profitable.
Right. I mean, you could look at, it's like the government didn't invent the iPhone. Right.
Good point.
The government isn't responsible for innovation.
Right.
They're
just making the rules. And so again,
just making the rules.
Smart companies are going to learn how to play within those rules and become profitable. And that's what the market is based on.
Yeah. There's good. Every company that isn't skewed Democrat or skewed Republican is not going to come out and say, oh, we can't make any money now because the opposing party took office.
Perfect. Good answer.
But it's just, this day and age, it's getting harder and harder to kind of try to sort through that and be neutral.
Well, yeah, because it's right in front of your face. So again, and we understand that coming from clients. It's something that
That's why I bring it up.
Yeah, we definitely talk about it. So it's a good answer. What do you got for me?
Sure. So the question that I had for you was, if we recognize that 2018 was a bad year in the equity markets, what are you doing as far as your investment strategy goes?
Right. So 2017 was a good year. Very easy to make clients money. The sectors did, rather well. 2018, not so much. Everything basically was negative, broadly speaking, except for cash. So we're not throwing our investment strategy out the window, but one thing that we pride ourselves on is that we are progressive, and we're not scared to kick the tires and look at improving things. And so we've hired Jesse, our internal analyst, who is basically gathering all of the independent research that we have access to and trying to make some sense out of all of it. Because we don't think that ultimately investment analysts are always right either.
True.
So we want to question them and make sure that the data the estimates that we are getting or the sectors that they're recommending investing in are appropriate. So actually what we're doing, we're in the process of using our investment strategy now for our clients. So I'm not saying we're changing anything, but in the background, we're testing, do we need to shift a little bit amongst those styles based on macro environment indicators so that we can protect our clients' assets a little bit more. So we're literally running a portfolio side by side, our current one, to see if there's ways that we can pick up value for our clients. So just the takeaway that for a typical client is that, yeah, we're not happy with 2018. Nobody is. Our process worked like it always has. The idea is we want to protect money on the downside, so we're looking to mitigate that. But can we improve? Absolutely. We think we can improve. And that's one of the reasons that you and I are in this industry, is that we're not just going to sit back and tell our clients, oh, it was a bad year, buy and hold, it'll come back, be patient. And sure, some of those things are true to an extent, but we wouldn't be doing our jobs if we weren't trying to improve our offering. And so we're constantly, I called it yesterday to a client, I said, we're doing R&D. Right, this is our R&D. We're making it better. Are you looking at my watch?
No.
Just making sure.
No,
sorry, I didn't know. I've got a nice watch, Corey.
I like it.
Anyways, we're doing R&D, and we're always on it. But you and I went to Wharton. We spent a lot of time studying this stuff. We're confident in our process, but we're looking to improve it.
That's good. It makes
long answer to your easy question, but I wanted our viewers, our audience to know, hey, these guys, they get it. It's a bad year. The process worked like it always has. But they're not sitting on their hands. They're out there trying to figure out a way to make it better.
I have to tell you a really funny, quick anecdote. I was meeting with a client yesterday who made a pretty astute observation when we talked about the same thing that you just kicked that point off with, that in 2018, cash was the top performing asset class. And he made the point, he said, so the old adage that you shouldn't put all your money in your mattress would have actually been the best way to invest last year.
Yeah, sadly.
Halfway jokingly, but it's pretty rare.
In 1 year, exactly.
It's pretty rare.
It is very rare. So let's move into our next topic, going along with the investments. And speaking of sectors, is we're going to put up on the screen now a picture of the Callan Chart. And I'm going to explain it to our audience, and then maybe you and I can kind of just elaborate on exactly how we use it a little bit. So the way that you read this chart is reading from left to right. The left column starts with the year 2000. And if you go all the way to the right, it ends in 2018. And every colored box on this chart represents a main style of the market. And they're ranked top from bottom, from the best performing group to the worst performing group. And it's in color to show you that it changes all the time. So you can't just leave your money in one thing and let it sit there. In our opinion, buy and hold does not work. So if you look at one of these boxes, we'll look at the year 2000. At the top was commodities. That would be things like gold or oil. And you can see commodities in 2000 was one of the best, but in 2001 it was one of the worst. 2002 it was the best, and so forth. So if you put all of your money in commodities or gold or oil and just let it sit there, in essence you're just riding this wave up and down. So what we do is we put an appropriate allocation in each one of these boxes. And then anytime one of those boxes gets more than 5% of your target weighting, we sell that extra 5% up high, and we go down and we buy what's not doing well down
Sell
low.
high, buy low?
Exactly. Have you ever heard that one?
Yes. Let me write that down.
And so we do that with great discipline. And the reason is we don't know what the future is going to be. We don't try to time the market. But what we do is it forces us to take profits when we make it, and it forces us to also buy into other things when they're cheap. Now, because we're fiduciaries, we're doing this because we believe it's in the best interest of our clients, and we also don't charge a commission when we do buy ourselves. So our clients know we're not getting paid any more to do this trading. We're doing it because we think it's going to not only protect their portfolio, but hopefully make them more money. Now, we don't have cash on this chart. I know you and I were just recently talking about cash, so it's not on here, but you can see last year, large cap growth was the best performing asset class, and it was actually negative. So again, nothing basically was up. So I would expect your bonds to be down. I would expect your U.S. stocks to be down, and I expect your international stocks to be down. And that's just what happened.
Are there any other years on that chart going back to 2000 where the best performing asset class is negative?
I don't know. Have you looked at it?
There's not.
Okay, trick question.
Pop quiz.
No, I don't know. I haven't studied it that because again, we just use it looking backward.
No, I know. It gives us an idea though of the rarity. Is my point.
So there's never been a year, at least on this chart. So going back to 2000 that we've had, so it is rare. So that's a good news for a client. It's like, hey, I get it. Things were negative. We didn't like it, but it doesn't happen all that often. It hasn't happened obviously in 18 years.
That's the point.
Right.
That's all.
Good question. Good pop quiz for me. So again, there will be no test afterwards, I hope, on this. But so what we do is we update this chart every year. We go over it with our clients. Our clients, the takeaway, know that we have a mathematical process. We execute this with discipline, and we stay on top of it. Now, as part of our offering, we obviously look at all of our clients' accounts manually, but we do have a software program that'll actually alert us if a client is out of sync. So our clients know, hey, if Jake's on vacation or Corey's going to the Super Bowl, are they watching my stuff? And absolutely, your stuff is being watched. So what would happen is alert would happen. We would know to go in there and check it. And if we needed to rebalance, we would make that happen. And I would find a lot of comfort knowing okay, my advisor has a process. He's going to sell when certain sectors do well. He's going to buy in when other sectors do poorly. And it's being watched even when he's not out of the office. They have software that's going to ping him or someone on his team to say, hey, we need to go.
Better go check this out.
We need to go check this account out and look at it. Good. Did I miss anything?
I don't think so. That's a good lesson on the Callan. And I know a lot of people have probably seen this.
Right.
And lots of people, there's lots of different variations of it. Ours includes the different asset classes that we invest in.
Yeah, exactly.
Right?
That's why ours is the way it is.
I think it is a helpful tool to actually give you an idea of what's done well, what's done poorly. Going back to our first discussion, though, about red flags is that if somebody tells you with confidence they know what the top box is going to be in 2019.
They don't know.
I wish I knew.
Right, me too. I'd make a lot of money.
Right.
For our clients and us. Yeah.
We don't.
Yeah. Nobody's been proven to predict what 2019 is going to look like, and so we don't try to do it. So what we do is we just take money off the table when it's high, and we go in and we buy when other things are low.
So at the end of 2017, theoretically, you were selling stocks and locking in gains, and maybe at the end of 2018, you were actually maybe selling bonds and buying stocks.
Potentially, absolutely. It all depends on each individual client's weighting. Exactly. But that's the chart that lets us apply the math to, again, protect our clients' money and then make them money, hopefully.
It makes sense. It's so counterintuitive to the way people think.
Yeah, it is. And that's another good point, is that we as humans are very emotional, and when something's going up, we think it's going to continue to go up. And when something's going down, we think it's going to continue to go down. But like we've talked about on previous shows, the market is cyclical and it's not going to do that. So you have to have discipline, and you have to be willing to sell your stock when it's up 100%. Sell it, it's high, and you have to be willing to buy that other one that's down 40%. As long as you think that stock fundamentally is still a good company and not going to go out of business, obviously,
right,
then you should be buying those shares when they're cheap.
Exactly.
And that's something that we do internally for our clients, and we take it very seriously, and we pay very close attention to it.
Good.
All right, good. So for our fun global topic today, I wanted to share with our audience maybe some good financial decisions that you and I have made. So why don't you start and share, maybe not, it could be the best, but if you had to look back on some of the financial decisions you have made personally, what's something that if you have done that you wish or that you would like to share with our clients that maybe could help them?
Okay. Yeah, so I have a good example of one that was... What I ended up doing is it wasn't a huge number, but I had some revolving credit card debt, which we all know is kind of the enemy, right?
Sure.
But I did have a balance on a credit card that I was aggressively trying to pay down and was making some progress, although I wasn't making progress as quickly as I would have liked because of the fact that the interest rate was so high. And a lot of people probably know, if they look at the interest rate that their credit cards are charging them, if they don't pay every single one off every single month, of course you should try to do that. However, long story, but the fact of the matter is there was a small balance that I had on a card that I wasn't paying off every month. So I was aggressively trying to get it paid down.
But you couldn't, right? And that's very common. It is
common. People ask me about it all the time.
Yeah, you can't get out from under it because the interest rates on these things sometimes are 20% or whatever.
Right.
So what did you do?
So what I did is there is a service online that I use that it basically aggregates all of my credit information. It's where I watch my credit score. It's where I look at liabilities. It's where I look at payments.
What is the name of it?
It's called Credit Karma.
Okay, and again, this is not an endorsement for any
Right.
third party. I just wanted to know what it was, buddy.
Not endorsing it.
But anyway, so they
That's why I signed up for it.
So they aggregate all of your credit, and then what happened?
Based on all of that, they said, you know what, we have lenders or we have partners that we work with.
So would you get a loan?
Mm-hmm, I did. So basically, because they already had all of my credit information, they said, it looks like on this credit card, you're paying more interest than you should be. You ought to explore online lenders that we partner with that will be able to help you basically consolidate that, pay it off, and then pay a much lower interest rate. So get a loan to pay it off and then pay that lender back, but at a fraction of what the credit card company was charging.
That's smart. So I know a lot of people will rotate balances to other cards, but rather than move it to another credit card, you actually went through some sort of bank and got a loan.
Yes.
Online.
Correct. Exactly. And here's what's really interesting about it. So it's one of those Silicon Valley sort of, tech startup companies. It's not really a startup, they're established now, but they have investors, people that actually invest money in their company, and then the company gives that money to people. Like the company gives somebody like myself or whomever a loan, but the money that they give to that person is money that someone else invested for a fixed interest rate.
Interesting.
So the interest rate that I'm paying, a fraction of that goes to the company. It's not.
Sounds pretty sketchy to me.
It's
I know it doesn't matter to you.
It's more legitimate than I'm describing, than I'm making it sound like.
I don't think it's sketchy on your end, but I don't know.
I've never invested in it.
Well, I know I'm not. Yeah. So again, I would be wary of that, but it doesn't matter to you because you're on the other side. You're getting the loan, and as long as the loan, it's not variable, is it?
Nope.
Is your interest fixed?
Fixed.
Gotcha. Have you paid it off yet?
Almost.
Good.
And it's
then you'll be done with it, I assume.
It's laid out. This is the dollar amount you'll pay per month. And it, from a cash flow standpoint, it might save somebody a couple $100 a month in terms of what they were paying on their credit card. But now it's going to get paid off in 2 or 3 years instead of 5 or 7 because you were paying so much more interest.
And you're going to pay less in the end.
Exactly.
Smart move. Good financial decision. I don't know about the sketchy bank that gave you the loan, but
I
guess it doesn't.
Maybe I didn't describe it well. But
so investors provide the capital that they loan out. Is what you're saying. Yeah, maybe that's the way the banking world works. I don't know because I'm not a lender.
Right. So. And it's not a bank that's down here on the street. It's they're if there's an interest rate, think about it. It's the same way that if they're charging a spread, right? There's a percentage that goes back to the person that put.
Yeah, it's just the way the bank's making money.
It's the same way that a bank makes money.
They're funding it through other investors.
Yes,
which is probably fine. I'm not accusing anybody either, by the way. I want to be careful of what we say. I'm not accusing anybody or suggesting anything. But that was more of a joke.
Right. No, but frankly, though, the reason that I bring that up is because. Fortunately for me, it wasn't like it was some awful situation that was spiraling out of control, but it was that I recognized what I'm doing on a month-to-month basis probably isn't the smartest thing for me.
Right.
And I'm a wealth advisor, right?
Exactly.
So my point is, if you feel like you're in that situation or something like that's happened to you, there's lots of people that end up in that situation.
Right.
And all I'm mentioning is, if you have a wealth advisor or you're researching options on your own, just recognize that, there might be somebody that might have some ideas who can help you out.
Right.
Or who's gone through something themselves.
Good call.
So what's your best financial decision?
I thought about this a lot, and I think one of the things that I've done that, looking back, I think was a smart move is that I waited to buy a house. I waited until I was. What did I think it's been. Did I buy that house in 2015?
Sounds right.
Yeah. So I was 33, 34-ish, somewhere around that years old before I bought my first house. So I rented a long time, and I saved my money. And what I was fearful of is buying, a quote-unquote starter home and then being forced to sell it and maybe not getting my equity out of it. You hear a lot of people saying, well, when you're renting, you're just throwing away money. But the reality is a house is not just your mortgage. It's, insurance, it's upkeep, which is very expensive, particularly if I would have bought an old home that maybe needed a new furnace or a new roof or the flooring or the foundation. Right. Yeah. So what I did is...
And personal property tax.
Right. Oh, yeah. Tax is a good point. So what I did is I just simply rented. I rented some really nice places in Kansas City. I got a feel also of what part of town that I wanted to live in. And ultimately when I selected a place, it was a place that near a place where I like to play golf. So I knew it was close to where I like to spend a lot of time. And will Rachel and I live in this house forever? I don't know, and that doesn't matter. But we bought a really nice house, and I had the money to put down a proper down payment, so I didn't have to pay PMI or that, was that property mortgage insurance or
it's private mortgage.
Private mortgages. So I had enough money to make an appropriate down payment, and we don't, we can raise a family in this house. We're not going to be forced to sell at any time, and we like that. We like having that. Flexibility. Whereas if we would have bought a small starter home and we wanted to have kids and we didn't have enough room, we would have been forced to upgrade, right? And that what that does is that potentially would create an environment where, well, now mortgage rates are higher, or maybe the housing market's not doing as well as it was before. And one way or the other, if you own a house and you want to go buy a house, you're going to be a seller and a buyer, right? So they always say, is it a buyer's market? Is it a seller's market? Right. Well, if you already own something, you're going to get maybe a bad deal on one end and a good deal on the other. Well, I didn't have that. I was always a renter. Mm-hmm. So I bought when it was the right time for me. And I got into the housing market when I thought rates were very low. I've got a nice low mortgage, and I got a house that I can grow into. So in my opinion, I tell a lot of our younger clients, it's okay to rent. There's nothing wrong with that as long as you are saving money for that eventual home purpose. If you're living month to month and you're scraping by and you're never putting away money, then you've got to do some more budgeting. Things maybe like you have done. Consolidate some of that debt so that you can save to do things right. And it took me a while, right? I was in my almost mid-30s.
True. Yeah.
There's nothing wrong with that. And I'm very comfortable with that financial decision, and I think it was a good one. It was a smart one on my end.
So it sounds like the decision, though, in the house that you bought and where you guys are at, while it's an asset, it's also a liability, obviously, if you have a mortgage, but it was kind of a quality of life thing, right? For you, it was, okay, I figured out, it took me some time, but I figured out that it might seem obvious, but being close to your office is important to you. Being close to where you play golf is important to you. Right? Those are things that, 10 years ago, you might not have had that all figured out yet.
Good point. Some people don't care about that. You know, they don't mind driving, because Kansas City is easy, but they don't mind driving 20 minutes to work. I do.
Or an hour. Some people do,
Right. And that's okay. But I got a chance to figure all of that out with a relatively low commitment. And I lived downtown. I lived up north, and I had these different places that I got to see. Did I want to really be in this neighborhood, for an extended period of time at least? So I was able to move around a little bit and rent. That's so good. I thought that was a good decision.
No, it is good.
So
it makes me feel better about still renting.
Yeah, exactly. You're probably doing that because of me. But again, as long as you're saving money, I mean, you and Cassie are going to be able to get probably a much nicer house than if you would have bought one a couple years ago just by yourself.
Correct.
So, anyways,
that's the plan.
Well, good.
I'll report back on a later episode.
Fair enough. So that's all the time that we have for today. Thank you all for tuning in. As always, you can find us on all of the social media outlets. Not all of them, I guess, but we're on Instagram, we're on Facebook, we're on Twitter. We have our wonderful YouTube channel. Our podcast is on iTunes.
LinkedIn.
We're also on LinkedIn. And you can find me personally on Twitter at Jake Falcon, CRPC.
And my Twitter account is at Corey Bittner, KC.
Thanks again for tuning in, and we hope you all have a great week.